Welcome to this explainer. Every major corporate expansion, every groundbreaking new product launch, and, every massive factory scaling up production all comes down to one absolute fundamental requirement. Today, we're going to dive straight into the literal lifeblood of any successful enterprise. We're going to unpack exactly how businesses actually fund their massive growth. Getting a grip on where the money comes from and the nuts and bolts behind it is absolutely crucial. It is your foundation for understanding the entire business world around you. So, think about it. How do companies build these massive factories seemingly out of nowhere? How on earth do they fund the intensive research needed to launch those incredible new products we all love? Or how does a local brand suddenly expand into entirely new cities? You see these grand expansions all the time, right? Well, every single one of them requires one core ingredient. The answer is incredibly simple, but the mechanics behind it are just fascinating. They need money. But where exactly does that massive amount of money come from? It definitely doesn't just appear out of thin air. And honestly, choosing the right method to get that money can literally make or break a company. Okay, let's get right into it. We're talking about capital. Capital is essentially the fuel. It's the money used to start, operate, and expand a business. Every single business out there, from a tiny tech startup coding in a garage to the massive global corporations dominating the stock market, they all need this capital just to survive and grow. And broadly speaking, when a business goes out into the wild to find this fuel, they usually find themselves standing at a crossroads with two main paths.
Let's look at path A first, debt financing, or borrowing to grow.
So what does this actually mean in practice? Well, debt financing means the business borrows a big chunk of money upfront, and they agree to pay that money back over time, usually with added interest. You're probably pretty familiar with this. It takes the form of standard bank loans, business credit lines, or if we're talking about much larger companies, corporate bonds. Now, the massive pro here, the absolute biggest advantage, is that the business owners keep full 100% ownership of their company. They answer to absolutely no one. But the heavy burden is the mandatory repayment. The business absolutely must repay that loan every single month. Even if they're having a terrible month and profits are drastically low, the bank doesn't care if you had a slow week. That payment, it's mandatory.
Now, let's explore path B, equity financing. This is all about sharing the pie.
Now, what's really interesting about this option is how fundamentally different it is from borrowing. Equity financing means raising money by actually selling a share of your business to investors. So instead of dealing with those stressful monthly loan payments, you're basically giving an investor a piece of the pie. They hand you the money, and they hope the company becomes far more valuable over time, so their slice grows in value too. This is a massively popular option for startups. Why? Well, mostly because they often just don't have enough steady income to even qualify for a large bank loan. Plus, investors don't just bring cash to the table. They often bring incredibly valuable business experience and mentorship. But there's always a trade-off, right? For all that cash and wisdom, founders have to give up a part of their ownership. And crucially, they give up a degree of their decision-making power. They literally have to share the driver's seat. So making the right choice, debt versus equity. All right, so we've got these two very different paths. Debt keeps your ownership intact, but guarantees you've got bills to pay. Equity frees you from those bills, but it costs you ownership and control. So how do business owners actually decide between them? Well, there's no single best choice out there. It entirely depends on the nature of the business itself. Businesses with steady, reliable income, they often prefer debt financing. They know they can easily cover those monthly loan payments, which allows them to keep complete ownership of all their hard work. On the flip side, fast-growing startups lean really heavily toward equity financing. They need massive influxes of cash and the strategic experience of investors to grow at lightning speed. And they're totally willing to share the ownership to get it. What you should really take away from this is that it's not always an either-or situation. Actually, many of the most successful companies in the world use a strategic combination of both methods as they scale up. Let's look at a real-world scenario, the coffee shop expansion. To really cement this in our minds, let's step away from the abstract corporate concepts for a second and ground this in something highly relatable. Put yourself in the shoes of an entrepreneur. Imagine you own a really successful, bustling little coffee shop. You've got lines out the door, the community absolutely loves you, and you are finally ready to open a second location across town. It's a huge milestone. But of course, building out a brand new cafe requires a lot of capital. So suddenly, you're standing directly at that financial crossroads we just talked about. Let's test drive both options here. Option 1, you go for a bank loan. You take the money, you build your amazing new shop, and you repay the bank over several years. The reality for you as the owner, You get to keep 100% ownership of that shiny new second location. It is all yours. But remember, you got to make that bank payment every single month, even in the slow winter season when sales drop. Option 2, bringing in an investor partner. They write a big check that pays for the entire expansion right up front. The reality here is pretty sweet at first. You have 0 monthly loan payments stressing you out. However, you now have to share the profits of that new shop, and you have to share the decision-making. If you want to change the coffee bean supplier or even the paint color on the walls, well, your investor partner might have a say in that. As you can see, the right choice for your coffee shop depends entirely on your personal financial situation, your comfort with risk, and your long-term goals. At the end of the day, business financing is the ultimate fuel that helps companies start, survive, and conquer their markets. Understanding this absolutely crucial difference between debt and equity financing doesn't just help the CEOs on Wall Street, it helps everyday entrepreneurs make significantly smarter financial decisions. Whether you're sketching out a plan for your very first business venture right now, or you're just inherently curious about how the corporate world around you actually functions, grasping these fundamentals gives you an incredibly strong foundation. So, I'll leave you with this. When the time comes, which financing path will fuel your next big idea?